And today I'm finally making one of the most asked videos or most requested videos. And I often get asked, probably at least once per day, what is the best time frame? What is the best time frame for the signals? Where do you have the best time frame for certain patterns? And I really want to address that with this video and provide an answer finally for all of you who are wondering about this. So generally, when we talk about time frame choices as a trader, we have to distinguish between the higher time frames, which is usually the weekly, the daily, the 4-hour, or the lower time frames, which are usually the 5-minute, the 15-minute, the 30 minutes, and also the 1-hour time frame is usually somewhere in between the higher and the lower time frames. So that is a little bit of an intermediate time frame, we could say. And when we talk about this, or when I go through all the different aspects and explain all the differences, we always have to distinguish between the higher time frames and the lower time frames, because that's usually where the traders make their decisions. Do you want to be a day trader on the lower time frames, or do you want to be a swing trader on the higher time frames? So that's the general idea where we focus on. And it's very important to understand as a little starter that different personality types are better suited for different types of time frames. So as you will see, there are different aspects for each time frame or set of time frames that we will discuss now when it comes to general emotional stability, how people like to analyze their charts, how they make their decisions, and that is what we will focus on. So when we take a look at the higher time frames, usually what is the general premise? Obviously, you have fewer trades per week because the signals are just not that many. It takes a lot of time. On the 4-hour time frame, you only get 6 candles in a day. You only get 30 candles in a week, whereas on the 15-minute time frame, you get dozens and dozens of candles every day. So you can already see the higher time frames, they move slower. You have more time to process all the information. You have more time to make your decisions. But at the same time, also, the holding time is longer. You will stay in trades much, much longer. You have to hold them for a long period of time. Whereas on the lower time frames, you need to be really quick on your feet. You have to make the decisions fast. At any given day, you probably have multiple trades per day. So you really have to get in and out of the markets quickly. You have to analyze the charts quickly. You need to be emotionally very, very stable, because on the lower time frames, if you're a day trader, it can happen that you have multiple trades per day. Maybe you start off with a few losing trades in a day, but you quickly have to shake it off. You cannot let those starting trades in a day influence your next decision making. You have to be very, very emotionally stable. And you need to be a much more active trader. So when it comes to this decision making and how we act on the time frames, how we perform our trading, then as I said, on the higher time frames, you only have a few trades per week. You have more of a longer term thinking approach. It's more a little bit of a long-term strategic mindset where you can really follow the markets. You can look at the different shapes. You have sometimes days, sometimes even weeks if you're on the higher time frames to make a decision, to come up with a decision. But at the same time, it can also happen if you are, for example, on a daily time frame, that the trade is almost ready. It's not quite there yet, but this little bit of extra waiting will maybe take 1, 2, maybe it's even 3 or 4 more days. In some cases, like in a recent example for the Euro Swiss franc, it took a few weeks until the setup finally happened. So you need to be very, very patient when you are waiting for the trades. And you have to be also very, very patient when you're in a trade, because on the higher time frames, obviously you stay in the trades much longer. The drawdowns and the swings in your direction, they will take much longer. You have to be okay if you are on the daily time frame that sometimes when price shows only a little bit of a retracement or a consolidation, then it can take days until this little consolidation is finally resolved. So you really have to be comfortable with patience, whether it is waiting for the trade or staying in the trade and riding the trade. Whereas on the lower time frames, obviously you have multiple trades per day. You have to react very, very fast. You also need to be much more focused, because so many things can happen at once. You have maybe news coming out, then the market suddenly moves. You have something unexpected hit the market, which you have to react to quickly. You need to be very focused. You have to avoid all the distractions from social media, Facebook, your phone, whatever it is, you have to be really focused on trading at the time frames and trading in the now. You have to really blend out all the distractions around yourself. And it is, you can see there's also a very, very big difference. When it comes to emotions, it's also very, very different whether you're trading the higher or the lower time frames. You need to overcome the need to trade when you're on the higher time frames. Many traders, we saw it last week that the beginning of the week, the first 2 trading days for our higher time frame strategy, there were not a few not good signals, maybe even non-signal. So many traders came a little bit nervous. They wanted to get into a trade because they did not trade for 2 days. What then happens often is they jump into early, FOMO catches, or boredom takes over, and then they get into trades they know they should not be in, but they are just having this need to trade, and that is very, very problematic on the higher time frames, where it's just normal that you have to wait sometimes for 2 or 3 candles, which on the daily time frame obviously it can be 2 or 3 days, whereas if you're on the 5 minute, it's just 5 or 10 minutes. You just go and get a coffee, and when you come back, maybe everything looks much better. So that's a very, very big difference. Also boredom, if you're easily bored, you need to have some action in your trading, or if you are in a drawdown, you want to make up for your losers faster, but you cannot force the trades on the higher time frame. So you really need to be more relaxed, more laid back, have a longer approach. Whereas on the lower time frames, the biggest problem usually when it comes to emotional trading is revenge trading, because the market is moving so fast. You can also almost always find an almost trade where there are almost all the signals there, but you have to wait a little bit longer. Then you can convince yourself, okay, this is almost a signal. Markets move so fast, it will somehow work out. And revenge trading is then a very, very big problem, especially if traders are not emotionally stable, not resilient enough. Then this can be very, very bad if you choose to trade the lower time frames. And you need to be focused and very selective on the lower time frames. You have many more signals in a day. You have probably a lot of markets that you can follow. So there are almost always a trade where it is almost ready. It's not quite there. So you have to be selective, only wait for the good ones, and then avoid the variance. When it comes to actually the technicals, there's not really a big difference whether you use the head and shoulders. The head and shoulders works the same whether you trade it on the 4 hour, the 1 hour, the 5 minute, the 15 minute. Trend lines usually work the same, roughly speaking. Moving averages, of course, you can use them on all the time frames because the moving average is just a way of analyzing the price action. Stochastics, everything works exactly the same whether you use it on the higher or the lower time frames. It is not the case that a certain signal will only work on the higher time frame. A moving average, a certain moving average is not only limited to one specific time frame. So it does not really matter what tools or what strategy you have, but the way it manifests on your time frames is a little bit different. On the higher time frames, usually speaking, the setup quality is a little bit better. You have usually a higher win rate, although this is not true for all the traders and all the trading styles. The volatility can be lower at times on the higher time frames. You don't have those huge intraday swings. Of course, there can be some swings as well on the higher time frames, but usually volatility is a little bit less on the higher time frames. And roughly speaking, the price action and the way the candles and the price moves is a little bit smoother on the higher time frames. Whereas on the lower time frames, the volatility is a much bigger factor. Intraday volatility spikes, spread is also a different factor. News have more importance usually when you're on the lower time frames, because even low impact news, they can move the markets on the lower time frames much more. At the same time, you have more flexibility on the lower time frames because there are just so many candles in a day. You can just wait out the news, avoid them very easily, and then wait until the news are gone, and then you focus on the next thing. So that's also an interesting factor. And also you can overcome variance much faster on the lower time frames, meaning you have more signals on the lower time frame. So even if you have a string of losing trades, you will get out of your losing streaks much faster. Speaking from a time perspective, because you will have more trades, you have a potential to get more good ones as well in a short period of time, so you can ride out the variance sometimes faster. Whereas on the higher time frames, obviously a downswing or losing streak can take a few days, sometimes even weeks. As I said, generally speaking, all systems can theoretically be traded on all the time frames. There's no reason why your head and shoulders only works on the higher time frames, or why a certain moving average only works on the lower time frames. Now you can use any system on all the charts, any tool you can use across all the time frames. The lower time frames, they have the same idea when it comes to price action. There's no real difference between the signals and the types of signals you can trade on the lower or the higher time frames. For example, in our Forex course, you get two strategies. One is for the higher time frame, one is on the lower time frame. They are basically on a very, very similar premise. Often we can even see that the lower and the higher time frames, they have the same trading ideas for different time frames. Although the systems are a little bit different and they certainly use different time frames, you can often see that the signals and the types of trades, they are very, very similar. So it does not really matter. It all comes down to how you personally handle the different time frames. You can trade all the time frames. No time frame is better than the other. Just no indicator is better than the other. Everything and only depends on you, your personality, the way you approach trading, the way you feel about emotions, how you make your decisions. You're a fast decision maker. Do you like the long-term trading approach? It only depends on you which time frame works best for you. I have seen that I trade my system on the higher time frames, which are usually the 4 hour, sometimes the daily. But I've seen that some traders take the exact same system, they use it on the 30-minute and it works well for them, whereas I cannot make it work that well on the lower time frame. It's the same system, the same signals, it's just a different way of approaching the market, playing out your edge, your personal edge, which is then your way of thinking, your decision making. And a lot also depends on lifestyle and time availability. So if you have a job, then probably day trading during the day is a little bit harder. You might gravitate towards the higher time frames or find certain periods in a week or in a day where you can block out chunks of time to find a time to actively trade on the lower time frames as a day trader. So you have to factor that in as well. And that's then really the whole answer. Again, no one time frame is better than the other. Signals and setups can be used across all the time frames. There are different implications when it comes to emotional requirements. Of course, volatility and price action will be a little bit different, but generally speaking, it does not matter that much. It all comes down to you, your way of thinking, your way of approaching the markets, and then you can make a good decision. I hope this helps. Again, if you have questions, leave it in the comments below. Make sure to give me a thumbs up if you like this video, and then I will see you in the next one. Happy trading and stay safe.